Reclaims. Woo. So today's video is going to be a build on the prior video that was discussing how to identify levels that matter. Not all levels are created equal, and not all of them are going to provide a favorable risk to reward. So how do we find a reclaim? Well, first you must learn to find a key level. Wondering how to do that? Watch the prior video. This one's going to be primarily on recaptures or reclaims. A reclaim essentially is recapturing a key level that can have a favorable move in terms of risk reward to the bull thesis that technically for the most part is in favor of the trend. You want to be able to capture reclaim trades, reclaim longs in this case, or shorts if the trend is in your favor. That gives you wind at your back and that provide a meaningful reaction from that zone. So from 35, 57, 35, we had about a 20-point pop, right? About three times. You can see here one, two, three, sorry, three on this one. Three times 20 points on each occasion. A level that reclaims over and over and over will not always cycle. The more times a level reclaims and cycles, it will at some point cave in or become messier and messier and messier. You can see that in the first instance, it was very clean, broke below. We held cleanly and then gave 20 points. We came back again. We tapped it, lost it by a couple points, immediately reversed. The second time around, we broke below, but it was very messy, and it finally paid the 20 points. So just learn to figure that as a level reclaims, there is a less than likelihood that the level can work in the same clean fashion, although the level can still be favorable for a trade as long as the risk to reward is favorable. Once the level breaks for more than 10 points and your stop loss has to be on that lowest low and you're looking for a 20-point take profit or on average or a partial scale out, you have to reconsider that your risk reward can be skewed even less and less as the level gets overworked or overrun. So just consider that as one of the things that these reclaim trades work when the levels are very fresh and new, not after they've been tested multiple times. So why reclaims? What is the philosophy around reclaim, right? Essentially, a lot of traders they are breakout traders. A lot of people love to short the break of a support or the break of a resistance for a breakout. This idea of a reclaim is capturing the failed moves of all that liquidity that gets stuck on both sides. So essentially, I'm flipping the idea of buying a breakout or buying a breakdown and flipping it on its head and saying, buy the recapture of the failed move. Why? Because these moves happen rather quickly and they happen rather viciously. And the reason is, as you can imagine, anybody who's a breakout buyer, this liquidity that broke out above a prior high, attempting to capture or capitalize on the continuation of this move, becomes a trap buyer or a trap seller if breaking below. And if you tie this into finding the reclaims in favor of the trend, so the trend is up and you have counter trend traders shorting a low attempting to break a support level like in this situation here, we were a part of a bigger picture uptrend. Let's zoom out and then we'll zoom back into where we're at. We were looking at this zone right here, right? We're obviously in a massive uptrend and we're looking to capitalize on failed breakdowns, failed traders attempting to trade against the trend that in turn become trapped and result in squeezes that can be favorable rather quickly. The thing about these reclaim trades is that they tell you if you're right away. There is no lag in between trying to understand whether or not your thesis is correct. Because as you can see, as many times, about 15 minutes, each one is a 10-minute print. You got 20 minutes of data here before a massive squeeze happens thereafter. And we don't even come back to the level, right? Same thing here, where you come in and you hold that lowest low. It's just telling you that those lows are being protected in favor of the trend. Now, if you layer on the DOM and order flow and those things as for a separate video, concepts that I use, such as the footprint chart, delta, the DOM, and on the pace of the DOM as these levels are trading. Layer in that information, it just gives you a higher and more viable trading strategy to give you more confirmation or validation that that level is going to reclaim and potentially squeeze out some sellers. And the same is true in the inverse, right? As you can see in this situation, we probably had a day where we had a lot of volatility where levels were cycling back and forth. But nonetheless, the key component here is taking advantage of trap liquidity. Trap liquidity meaning trap traders, right? Every single strategy that I do is based on finding trap participants in the market because there is nothing more favorable in terms of risk to reward. Although win rate is less, I prefer having a lower win rate and a higher reward factor for all my trades. So I'm always looking for these trapped opportunities where there is ranges that have cycled that coincide with major levels of interest from a macro picture, right? Event-based levels, is this a CPI high, Fed meeting high or low? Are we in an uptrend? All these things that I discussed in the prior video, I'm cycling into this philosophy of reclaims. Here's another example of a reclaim from the most current session. It's October 10th. And we're going to dissect this right now. We're going to eliminate these levels. Start from scratch. Thing is that in order to identify these reclaims, they can happen intraday. They don't have to be macro levels. They can be smaller time frame levels. Although I prefer the bigger moves, so I personally just will annotate them intraday for reference points for my own trades. But they can be found, and the science behind it is it's always number one, magnitude of the move off a zone. So magnitude of the move off the level. Okay. If the level is favoring me 10 to 15 points off the zone, I'm interested. I like that level, okay? Because I know that I can maximize somewhere between 8 to 10 points minimum on my scale out because I scale my trades. I don't take profit in one zone. I look for a trade that can minimum give me 10 points, and I conservatively take profit at about 8 or 9, depending on momentum and context. And then I scale some more on the 15, 12 spot. Okay. Then my average scale ends up being around 10 to 12 points, or 10 points on average on the scale. Okay. So how do I identify number one, magnitude of move? Well, if you look here on this little consolidation area intraday, we can see that we're having some meaningful bounces, right? You're having some bounces off a level, off the high and off the low. So we see the trend is up, so we favor the upside in this situation given the overall context of the market. So we can see here that more or less the low ends up being 55. This is kind of where we broke down from. Price traded above, and then we traded as high as 61. Then my mind starts to wonder, okay, well, that's about 10 points. It's more like 8, but it's pretty favorable. Personally, not going to be sizing this a little bigger, given the magnitude of the move is not full 10 points. The rotation is, the move off the zone is about a little under 10 points. Nonetheless, pretty interesting. So then the thesis becomes trap liquidity, right? Can we trap some sellers? That's always part number 2. Can we trap liquidity? Okay, this could work for sellers or buyers. Trap liquidity, trap traders, or trap traders. Can we form them? So then the question would be, let them break it. Let that level break and see if it can reclaim, right? This is the reclaim zone, just to kind of make sure we're on the same page. Now that we've identified a bounce off the zone in favor of the trend, reclaim becomes this level. We'll annotate that on our chart. I do this every day on my live stream or on my charts as the day goes on. And then we let price break. Now, the second part of this all is you never really want, and this is a loose leaf unspoken rule, but you never want the level not to break lower than 2 to 7, no more than 10 points. Okay, you never want a level to break more than 10 points because a full rotation, a full move on the ES, one full move on the S&P, okay, this is for the S&P, not the NASDAQ. NASDAQ has different occasions, we'll do 3A, is 10 to 15 points. That is a full rotation in a general trend, any trend. If the ES goes below or breaks below more than 10 points, the probability of that level being reclaimed and working substantially drops because we've lost a full rotation. There's no other way for me to explain this besides saying a full rotation. If you understand what I'm saying, then do some homework. But if the ES in this situation drops more than 10 points from a reclaim level of interest, I'm no longer interested. The reclaim opportunity is now lost and the trend is now shifting. So in here, there is no coincidence that the ES broke up until about 45. What is the low here? 45 from the 55 to the fucking tick. Wow. I had no idea. 45. Typically, anything more than that, I'm not really interested generally, and we're gonna kind of recap this again with the prior example. The ES literally dropped to the set 10 points from that reclaim level of interest, and then retraced and reclaimed. Wow, does this look familiar? This looks a lot when it reclaimed the 35 that we spoke of earlier. We reclaimed this bad boy here, and we squeezed. So we're going to color it differently just to make it look pretty. We reclaimed, in other words, we recaptured the level. Now, the context is going to be very important when you're looking at the depth of market. DOM, I like to use that in conjunction with the trade. There's no way I'm going to find the confidence to just buy a level after it recaptures without having the depth of market in place. But this is more or less to cover the principles of reclaims. Okay, there's another layer of information that I'm going to be making another series on, which is the DOM. You're going to need the DOM for my personal taste to have more validation on the trade. So we see the level reclaims, and then what happens? We immediately thereafter squeeze in the similar fashion that the 25s when the 35s reclaimed on the prior example. This pattern repeats itself over and over and over. We sell down, we trap sellers, and then we reclaim the prior level, and then we squeeze out those sellers. There's no coincidence that these 10 minutes, these two prints here were very aggressive. There's no coincidence. The reason it was so aggressive was primarily due to short squeezing, probably. Okay, there's no coincidence there that at the same time we broke below, sellers tried to take advantage of maybe some sellers again, and they recaptured it. And look at that, another squeeze looking print. Why? That level is a reclaim zone. It's a level that there is a war where bears are attempting to fight the trend and short a level that the bulls are trying to sustain and hold. And every time it breaks and it trades below, we get more breakdown traders that pile in. More traders that break out and pile in, the more liquidity that gets stopped out upon the reclaim. There is one more layer to this that is my preference, adds more validation, adds more meaningful validation. I don't know how to phrase it right now. But this layer doesn't have to happen, although I love when it does, because it creates FOMO, which then in turn leads to more traps. That is when there is a flush or a squeeze, in this case, of a zone. If you're looking to short a failed move up, you want to see a squeeze into that level because you get FOMO buying up. Or you want to see a flush below a level. You want to see the level break down very aggressively. In other words, I want to see the level break viciously. Because when you have vicious moves, when you have very aggressive sells or very aggressive pops, get momentum. And momentum gets a lot of people to pile in. When you have more people piled in, there's more stops to trigger, which means the reversal is that much more favorable when it recaptures. So this one doesn't have to happen every time. Although when it does, it adds a layer of confluence for me that I love to add more size because I know that if I'm right, I'm going to be rewarded right away and I'm going to be able to scale out quickly and my risk to reward over time will be more favorable. So this last concept here, you can see played out in this scenario. You got a failed move from the 55, big sell, only to be recaptured and then break and squeeze even further. No coincidence there that when we broke down this time around, it was a very choppy sell. We had no real magnitude, no flush, no real momentum. That when we recaptured the level, it was very slow, right? It was very slow in accepting the level, and the move was very controlled, albeit very very trendy, but very slow. And there's no coincidence that when we flushed, we immediately reversed quickly and squeezed out more participants and formed a new high. Same thing can be said with all these metrics that I just explained with the prior price action at the 35s. If you go back to this zone here, you can see that the trendiest move came off the back of a magnified flush. You can see here the cleanest move to the upside came on the back of a flush. The drawdown was very limited. When you got in on the reclaim, there was very little drawdown experienced. You have messy price action like this, it is very difficult. It adds a layer of complexity to those reclaims. When you have flush moves, you get better and cleaner results for these trades. Now, that's not needed for the reclaim trade to work, but most times it provides another layer of confluence that can give you more confidence. Now we're going to do the fun one, the one that's a little messier, and that's the NQ. If there's any trade that I prefer to take on the NQ, it's always the failed moves on the NQ because those are usually very trappy, as you know, but they pay out quick and hard and massive. And if you can see here, this is October 12th, the time of this recording. We have failed to break out past that 475 area on the NQ. We failed 3 times. Okay, and every single time, another layer that I like to add, and this is just an um, extra information for you if you watch to the end of the video. God bless your heart. I like to add the VWAP second standard deviation to the NQ in conjunction with these failed moves. And I always layer them and I will put in golden levels on the NQ as to what those zones are. That can provide these levels of opportunity. Because when I have these 3 concepts, right, that I just explained, those 3 concepts that I just explained, when we have all those and we layer it with a second standard deviation VWAP move, and a reclaim, in this case, a reclaim to the downside. In this case, this could have been a bear scenario. You have an 8 plus setup on the NASDAQ because it loves to run liquidity and then retrace and revisit the prior range. And this is more of a mean reverting strategy on the NASDAQ, but sometimes these mean reverting trades end up being full trend day moves. And so on the NQ, if you were to zoom out, we can see that we had one failed move previously here on the breakout. And then once that high forms, that's a daily high, we then use it as a reference point for the coming session. Can we break that high? If we break that high, can we tuck in below? So we have a daily high that breaks. You get people enticed. You get buyers wanting to buy the breakout in hopes that there's going to be a trend move, right? And we're trading at a second standard deviation. And then you wait for it to come in below that high for a failed move, and then you have that beautiful flush that comes thereafter, and then you have an attempt at it again, and then flush again, flush again. Now this was the counter trend trade. We were on a trend up, but nonetheless, the principles apply in mean reverting strategies. You can see the NQ did the same thing here in this regard, and it did it before on the morning of. You had a meaningful move to the sell side on the NASDAQ, right off the open. Broke the prior low. The prior low was give or take here, right? This was the range low from the morning as we opened. We reclaimed it, held, squeezed, then trended. The move happens day in and day out. Question is, can you identify the reclaim using these principles that I just explained? The most crucial ones will always be found at prior day highs, lows, week lows, event-based highs or lows. Those are going to provide the most critical risk reward entries. So if you layer on the prior video that I put out on levels and you compile this into this information here, you have yourself a nice mean reverting reversal blueprint. It's not a strategy, it's just a blueprint to identify trap participants to be able to create reclaim scenarios. None of this is meant to teach you to trade or execute a trade. It is simply to create blueprints on how to find these opportunity zones using and compiling levels, price structures, the concept of trap liquidity, and then up to you to decide whether risk reward is favorable for that trade. The next video will be more segmented towards the depth of market and using the information found in the depth of market to identify the execution and entries on these trades. Make sure you subscribe and stay tuned.